And joining us now, we're talking taxes on the farm, a topic that a lot of producers definitely need to think about the next few weeks ahead and into the beginning of the year. Joining us with Pinion, Jeff Bear is here. Jeff, good to catch up with you, sir. How are you today?
Doing good, Jesse. Doing good. Glad to be here.
Thanks for the time, Jeff. And I know this is a topic that a lot of farmers, their operation, they got to be thinking about here as they are wrapping up harvest and getting into the final few weeks of the year and into the beginning of 23. And, there's a lot of things that go into taxes and managing your operation on the farm. And I'd have to think, for starters, making sure you got that correct entity structure for your operation is going to be probably a big key for many folks, Jeff.
Yeah, we get a lot of phone calls, and when we get out to meet a lot of operations, particularly ones that, 2 years ago were 2 or 3 thousand acres, and now they're 5 or 6, or maybe they were 5,000 acres a couple years ago, and now they're 7 or 8. So many times they're still operating under the original structure that they started with. So maybe that's just as a sole proprietor on a Schedule F, or maybe it's a partnership. And what you find out is as your operation grows and its complexity grows, if you can restructure some things, you can take some tax off the table really easy without really doing anything above and beyond that. A perfect example is so many times we get there, and these operators have accumulated real estate land over the years, and they've either just keep it in their Schedule F, or they keep it in their partnership. And when you pay taxes, there's really three types of taxes you pay. You pay federal tax, state tax, and if you make a profit, you're going to pay Social Security tax on that, which is an additional 15.3%. Well, in the tax code, if you're in the rental business, you pay regular tax plus state tax, but you do not have to pay Social Security tax. And so if you either keep your land out of your entity, or you create a second entity, say a partnership, and you have your operation pay rent just like you would to any other individual that you're renting ground from, you're basically taking income that would be subject to regular tax, state tax, and the 15.3% Social Security tax. And you're creating an income that is then subject to only regular tax plus state tax. So you take that 15.3% off the table. And that
Mhm.
is just a simple restructure that we run into a lot out there. You can go much deeper than that. If they're consistently making a profit year in and year out, you can take a look at creating an S corporation for your operating entity, because while those are subject to regular federal tax and state tax, profit there is not subject to Social Security tax, as long as you take a reasonable wage out of there. And I could get into all of the legal liability issues why you should separate your operation and your real estate and your equipment, but I am not an attorney, so I'm not going to
Mhm.
give a lot of opinion there, other than to tell you, you shouldn't have all that wrapped up in one entity and put everything at risk, especially now with, most of these operators own several semi trucks that are running up and down the road every day. Something happens there and there's a liability that's greater than the insurance covers, they get to come back to that entity for whatever that difference is. And you really don't want to have your real estate, which is your biggest asset, tied up and available for somebody to say, hey, you got to sell that off so I can satisfy that.
Well, we hope that most folks have the correct entity selected, but it's always a good reminder to make sure that they look into that and do. And it's also a good reminder, Jeff, that if they don't already or not thinking about it, I think sometimes we hear from various farmers they wait until the last minute, but they need to be working with their tax advisor now through the end of the year to really look at their balance sheet, sharpen the pencil, and figure out if there's any areas they need to take a look at to maybe save on taxes.
Yeah, I think, again, so many times as you grow and get bigger, you were accustomed to how it's always been. And a lot of times that was maybe giving a few numbers to your CPA in early to late December and saying, how do I look? Or the big one, doing it out of my head. Oh, I know I have approximately this much income. I need to spend this much money. The problem with that is as you get bigger, it's hard to keep all that straight in your head. And so what you see so many times when we get called in is somebody who has inadvertently created a huge loss the year before. And so they, they could have sold more grain and wouldn't have had to have carried it over. Or they missed the mark the other way, and suddenly they have a $150,000 tax liability that could have easily been managed if you would have just worked with your advisor all year long. And I also know a big thing we're seeing now with inputs having more than doubled last year. We're getting a lot of phone calls because a lot of these producers had been working with the local bank in town, and all of a sudden their operating note, needed to be 5 million instead of 2.5 million, or it needed to be 10 million instead of 5 million, and all of a sudden that bank can't take care of them anymore. And so, you get a phone call, hey, we're talking now to a regional bank, but we're having a hard time getting the loan through the credit analyst because we just don't have good financial statements, or we don't have the quality of the tax return. And so there's a big need to work with your advisor all year long and be getting those financial statements on a monthly or quarterly basis, so you have them, not only just because it helps with tax planning at the end of the year, but also because if and when you are being pushed to a bigger lender that isn't the guy you went to school with in grade school and knows you've got to produce really good solid financial data in order to make that shift.
Very, very true. Very, very true. Well, and you brought up as well the cost of inputs. And I think that's another thing that farmers need to think about as well with the cost of inputs. Maybe they're doing some prepay, they're looking at storing grain. Talk to me about managing your push. What does that mean, Jeff? And what are some insights you'd have there?
Yeah, so the push is kind of the industry's name for, when you're pushing grain to next year or you're prepaying expenses for next year. So many times as these producers, went from small to medium sized to large, they've just always been conditioned to say, and a lot of the smaller firms will just say, well, just hold your grain, don't sell it till next year, prepay some expenses, and then you don't have to pay any income tax. Well, that's true, but if you're holding $500,000 worth of grain till next year and you're prepaying 750,000, well, you've got are prepaying 250,000, all of a sudden the next year you've got 750,000 of income before you even get started. And as that number grows and gets bigger, it produces a lot of problems. So one is, if you get to the point when you want to retire and you stop one day, all of a sudden that push is taxable all in that year. A lot of producers will say, oh, well, I'm never going to retire, but my sons are going to take over. Well, under the IRS standards, the minute you stop, even if you're not selling everything, that push becomes taxable today, the day you take your name off that partnership. Great case in point, 2 years ago, I had a gentleman call me, asked me to come visit him. And he said, Jeff, I'm going to retire in 5 years. I have a son who works with me, but he has no interest in taking over. So I have about 5 years, but I keep having this nightmare that when I stop, I'm going to have to sell one of my 3 farms just to pay Uncle Sam. So he gave us his push numbers, and we went back and did a calculation. And, where he was at on that day, it would have cost him $950,000 to stop farming, which would have cost him, he would have ended up having to sell off about a third of his acres in order to pay that bill just to stop and retire, when in reality, a lot of his income in retirement was going to be renting that land out to somebody else. So there are ways to take care of that push. The best and easiest one is to try to manage it from year to year. Okay, you don't want to pay a lot of taxes, but sometimes paying taxes at the 2 lowest rates is the best answer because it helps minimize that, without a doubt. If you do have a big push and you want to kind of restart that all over again, there are some complicated ways that you can go through. You can't get out of that tax, but you can kind of lock it up and pay that tax over a 10 or 15-year period, and then go ahead and push the button and restart again. But that is a big nightmare as that industry's owners get older and get ready to transition that to the next generation.
And that's a great point you brought up with that whole talk there as well. Just the thoughts around looking at succession planning and planning for that next generation. I know that's a whole other issue that really a lot of folks need to take into consideration on the farm, not just looking at taxes say this year, but just in general, having that plan in place is huge, Jeff.
Yeah, absolutely. And like I said, tax planning is really so much more than just, I don't want to pay any taxes this year. Okay.
Mhm.
Maybe we don't want to pay any Social Security tax, but we're okay paying a little federal or state tax, because sometimes you can pay 25 or $30,000 worth of tax, but take three or $400,000 of the push off the table. It's a great way to do it. But the other big thing in talking with succession planning is so many of the current operators haven't dealt with succession planning or even with their estate tax. And right now, a lot of these operations have accumulated fairly large tracts of land. I mean, if you just own 1,000 acres of land, but that land is worth $8,000 to $10,000 an acre, look at what that number is.
Mhm.
And between now and 25, that estate tax limit is 13 million and some change per person. So if you're married, it's twice that. But in 2025, it goes back to 5 million per person. So if you haven't done any estate planning, there's really a big opportunity over the next couple of years till 25 gets here to do something about it, and really bring that down, because it's not uncommon for us at all to get a phone call from a family whose mother and father have passed away, and unbeknownst to them, there was, no trust or estate work done, and all of a sudden, they owe $1 to $5 or $10 million in estate tax, and they have to actually sell off land to take care of that. Well, all of a sudden they've shrunk, and it's not just dad anymore, it's the two brothers. So now you've shrunk the size of your operation, and there's two of you that have to make a living out of it as opposed to one. So I
Lot
think,
of yeah.
yep.
I was just going to say a lot of things to consider there, Jeff. A lot of things to really think about, and I think as well, just in summation, before we kind of wrap up, too. I know folks like you and the team there at Pinion can really help producers if they have these questions, and just thinking about everything that goes into tax planning, estate taxes, succession planning, everything we've covered today. Any other final thoughts you'd have for us to share, possibly?
Yeah, I think the big thing is most operators have been conditioned or brought up in an environment where have been able to manage most of these things on their own. But most operators that we get out now and talk to, it's a common to hear them say, over the last 5 years, we've doubled the number of acres that we're farming. And I think that the need to have a CPA, an accountant, an advisor who's involved with you all year long, because it's going to make it easier to finance that growth. It's going to make it easier to control taxes. It's going to make it easier to help mitigate the push. We're going to make sure to help with the succession planning from the first generation to the second, and even the second to the third. We bring a value that will more than pay for itself if you just make that phone call, whether it's us or somebody else that does the same thing we do.
Well, I know folks can learn more about Pinion online, pinionglobal.com, and get in touch with folks like Jeff there at Pinion today to get a little advice. Jeff Bear with Pinion, I appreciate the time. Thanks for joining us here today, and we'll have to get you back on again the show sometime soon. Thanks so much.
Thanks, Jesse. I appreciate it.